Joining us now to discuss all of this is White House Council of Economic Advisors Chair and President Trump's new pick to replace Fed Governor Kugler, Stephen Miran. It's good to have you, Chair Miran. First, you must be pleased to see another inflation number that comes in a bit light and does not show a lot of evidence of tariff pass-through.
Good morning, and thanks for having me. And yes, I can tell you that we're very happy to see that inflation continues to be well-behaved. Since the president took office in February, CPI inflation has been running at a 1.9% annualized rate, which is a totally normal pattern of behavior for inflation and for prices. And as you pointed out, look, there's just still continues to be no evidence whatsoever of any tariff-induced inflation. I think lots of folks who are expecting that, who are predicting doom and gloom, it just hasn't panned out, and it continues to not pan out for them.
There's a little evidence. I saw it in coffee. I saw it in tomatoes. You see it in photography, equipment, that sort of thing. But to your point, it's not filtering through into the headline numbers. And even the goods prices look better in July than they did in June. I guess the question, Chair Miran, is it coming? Because a lot of the economists still say, all right, well, these companies are still working off of their inventories. They had months of inventories. They can't absorb it indefinitely.
Well, there will always be relative price changes. There will always be one good or service gets more expensive and another one gets cheaper. That will always happen. But at the aggregate level, when you look holistically across the inflation data, there's just no evidence of it whatsoever. And that's an exact repeat of what happened in 2018, 2019, when, again, the same doomsayers, the same Cassandras were saying exactly the same thing, and it didn't pan out for them then. Thus far, it's not panning out for them again. Could it happen in the future? As I've said before, never rule out anything, but thus far there's no evidence of it, and the entire burden of argumentation is on the people who have been waiting since January 20th, the tariffs began, right? It's been a gradual process of different tariff regimes, but we started putting tariffs on various countries on January 20th, and still hasn't panned out.
No, it hasn't panned out, but, one thing that did surprise people, what core numbers were a little bit hotter. I mean, nothing crazy, nothing extreme, but that core number is now the highest year over year since, I believe, January. So what does that tell you? I mean, does it concern you at all that it looks like the inflation numbers pretty much bottomed earlier in the year?
Well, let me say a couple things. First of all, if you look at core, as you just mentioned, two of the strongest categories in this month in terms of inflation were used cars and airfares. And neither of those have anything to do with tariffs. We don't import used cars from abroad in large scale, and airfares are on domestic services, basically, right? So they couldn't be farther removed from things. In terms of core overall, look, we've been doing a lot of thinking about just how much of this inflation is due to the illegal immigration that's occurred in the last few years. Our calculations are that the massive insurge of renters into an only sluggishly adjusting housing supply probably boosted rents by about 4 or 5%, right? And that's a significant contribution to overall inflation at a time when the housing stock adjusts only slowly, inflation is very strong, and you basically got an unchecked border with people just streaming over this country. So we think that there's a very strong reason for thinking of very profound service disinflation coming up in the near future as net migration has come to zero because of the president's strong border policies and as we start sending numbers of them home. Right, and that's on top of the president's other policies of deregulation, expanding the capital stock through the incentives for investment in the One Big Beautiful Bill, energy abundance, keeping energy prices down. There's a whole of government approach to disinflationary policy that's going to be working its way through the inflation data and having a very profound effect in the near future.
Why wouldn't used cars and pricing in used cars be affected by an increase in prices in new cars?
Well, but there was no increase in prices in used cars this month in terms of in any material sense.
I mean, as an overall working theory, wouldn't you assume that if new cars get more expensive, people would turn to used cars, which would then inflate their value?
Yeah, they're substitutes, and a logic like you're describing would happen if the price of used cars had been going up, but the premise is false. If the price of new cars had been going up, but the premise is false. There wasn't any material increase in new car inflation on this month, which means it's just an aberration of the data, or maybe it's sort of, previous lags, correlation between different measures of used cars working their way through the system. But it's just really difficult to get to a point at which you could say any of the inflation is due in any economically meaningful sense to the tariffs.
Should we trust this data? The president cast a lot of doubt, politicized the head of the BLS. That's where these numbers are coming from.
Well, look, not all, but most economic data ultimately comes from surveys. And so there's always going to be an element of noise. There's always going to be an element of uncertainty. And unfortunately, that element of noise and uncertainty has increased in recent years. If you look at, we can sort of speak about revisions in the payroll, in the jobs data, because we get revised data for that. We don't really get revised data for the CPI data. Those never really get revised. The final number is the initial number is the final number. Of course, the seasonal factors get revised, but not the underlying data. And if you look at the jobs data, though, where we can speak of this, the birth-death model, for example, one of the big drivers of how you think about how job creation has occurred, has come from a run rate of about 5,000 or so annual jobs in the annual revision for the 15 years running into COVID, to being about almost 300,000 in the last couple of years, right? So that's an increase of about 70 times in the size of that error, right? So this is a degradation in the quality of the statistics that has occurred, and I think the president is dead right when he says we need to fix this. We need to make these statistics reliable. We need to make them believable. We need to make them credible. And I'm really delighted that we're shaping up to be able to do so.
What do you think drives response rates higher?
Well, I think that and to be clear, this is not my equity, this is not my policy domain. But I think that we can start thinking about incentive schemes to drive response rates higher. I think that we can start thinking about ways to optimize the collection system, optimize the survey system, optimize the timing of responses. I think that we should be thinking critically about these questions.
Yeah, I mean, it's certainly response rates collapsed in COVID and just was never able to get back to those prior highs, which were already eroding before the pandemic. A lot of attention was paid to your paper from last year about Fed independence in the last few days. Can you talk about how you expect to be questioned about it on the Hill and what your framework would be as to what kind of Fed is acceptable, as you say?
Well, I mean, look, I've always been clear that independence of the Fed is of paramount importance. But I do have a nomination going in front of the Senate, and I really can't speak about that and get ahead of the Senate process. And so I'm very happy to talk about administration economic policy. I'm very happy to talk about the economic data and the unrolling of the economy. But talking about the Fed is just not something I can get into right now.
Do you think you will get in the Fed before September 17th, which is the next meeting?
Again, that's up to the Senate, and I can't speak for them.
Do you think? I mean, look, the market, as I mentioned, is like 90% certain that we're going to get a rate cut in September. Though, there's plenty in this report, as evidenced by Carl Barkin's comments at the top of the hour. There's still a case, don't you think, to wait and see on tariff inflation, on services inflation, which we saw heat up a little bit, and the rent prices and the dental and medical cost area, that sort of thing. I mean, do you think it's a slam dunk that they're going to be cutting?
Look, as I said a moment ago, I do think that inflation has been well behaved, particularly since the president took office and completely changed the slate of economic policies in every part of policy that the executive branch can control directly from the presidency. However, as I said a moment ago as well, I just can't comment on current interest rate policy at the moment. Yeah.
So who's paying? So I have shown yesterday. I showed a chart. $29 billion was collected into the U.S. Treasury in tariffs last month, and this just numbers above $150 billion year to date. Who's paying for it? If we're not seeing it show up in a meaningful way in consumer inflation.
Yeah, well, look, in the long run, the arguments about tax incidence will hold sway. And in the tax incidence literature in public finance, the field of economics, the basic result is that the more inflexible party bears the burden of a tax or a subsidy or whatever it is, right? And at the end of the day, the American public is very flexible in terms of who they buy from. We can buy from other countries that we set varyingly high or low tariff rates on, and we can make stuff at home. That flexibility gives us the ability to shift the economic burden of something like a tariff onto the country that we're tariffing. So in the long run, I have every confidence that these tariffs will be borne, that the incidents will be borne by the countries that we're tariffing.
And then as far as whether it's working or not, do you have enough evidence at this point that the investment is coming through in a meaningful way to shift, say, the manufacturing outlook, the investment outlook in this country, that it's working in that way?
I think the commitments that the president has brought home in part of these historic trade deals speak for themselves. $500 billion here, $600 billion there, $1 trillion somewhere else. Pretty soon you're talking about real money. And those are real commitments. Those are coming through the tax incentives in the One Big Beautiful Bill to full expensing on structures, full expensing on R&D and new factories. All of those are incredibly powerful, and it's going to follow through.
Stephen Miran, we appreciate the time today. Thank you very much. It's good to see you.
Thank you.